Hey guys, before we get started with today's show, I have some exciting news to share. Your financial pharmacist is now offering fee-only comprehensive financial planning services led by certified financial planner Tim Baker. We're dedicated to serving pharmacists like you who want something better than the status quo. We offer our clients an honest, education-focused approach that is specifically catered toward handling the high-income, student loan-laden, demanding career track of you, the pharmacists we serve. Our goal is simple: to get you from thinking, I don't know exactly what to do with my money, but I know I need to do something, to confidently saying, I know exactly what I need to do month in and month out to get out of debt, save for retirement, and achieve my financial goals. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com.
The credit score is really a number that summarizes your credit risk based on a snapshot of your credit report at a particular point in time. It's really the picture of your ability to pay back a loan over the next 2 or 3 years. So the higher your credit score, the more likely you'll be able to pay back the loan and on time.
You're listening to the Your Financial Pharmacist podcast, a show all about inspiring you, the pharmacy professional, on your path towards achieving financial freedom. Hi, I'm Tim Ulbrich, and on this week's episode, Tim Baker and I discuss credit, a not so exciting but oh so important part of the financial plan. We talk about what makes up a credit score, the impact of good or poor credit, how to find and interpret your credit score, the difference between hard versus soft credit checks, and how to protect your credit. Hey, what's up, everybody? Welcome to this week's episode of the Your Financial Pharmacist podcast. And today, Tim Baker and I are going to be talking all about credit. So Tim Baker, welcome back to the show.
Yeah, I think it's been a while since I've been on a full episode. So it's good to be back.
It is. I feel like every time we do this, we say that, and then we say we're going to do more of it, and then, it ends up being a while, but we are going to do more of it in the future. And we have been doing more of it with the Ask a YFP CFP segment of the podcast. So Tim, credit as it relates to the financial plan, and with YFP financial planning clients, credit is a presentation. It's a module that you walk through. And I think many people may not think about this as a core part of the financial plan, and perhaps not even covered by many financial planners. So talk to us about, why is credit such a big part of our financial planning services that we offer, and what's really the goal of talking to clients about this topic?
Yeah. So I think there's, I kind of look at, the financial planning. You have the core pieces that, like the CFP board, teaches, and there's curriculum for that. And that's the things that we talk about, which are, kind of budgeting, cash flow, your balance sheet, tax, insurance, investment, retirement planning, estate planning. Those are the things that are debt management, not necessarily student debt, but overall debt management. So those are the things that we kind of talk about as core to the financial plan. And we do those things, at YFP Planning, but we also have kind of adapted our service to talk about more things that are kind of top of mind for a lot of our clients and kind of what they're experiencing. So those are things like, hey, Tim, I'm buying a home. Like, what do I do? And, very, very much related to that is credit, is making sure that the credit is pristine and looking good. It could be planning for a kid's education, salary negotiation, things like that. So we kind of real estate investing. Most financial planners are not going to get into real estate investing because, they're not necessarily paid on the assets that are in real estate portfolios. So we kind of drift a little bit to kind of adapt our service. And I would say credit is one that a lot of people don't think about, but we often do it in tandem with the home purchase to say, hey, if you're going to make the biggest purchase of your life, and I'll put in an edit on that. It's because I have clients that are like, well, the biggest purchase of my life is my pharmacy, my PharmD, and I'm like, okay, if you're going to make the biggest purchase of your life at one time, you want to make sure that you get the, you have the best, your credit is as best it can be, and you get the best terms. So a lot of people, and I can say, we talk about mistakes, that we've made in the past. I know, like in past life, like I was afraid, that my credit score, and I never really checked my credit. So I remember renting an apartment way back when. This is kind of like I was getting out of the Army, and I'm like, I wasn't always, as great a saver, and I would carry credit card debt and all that kind of stuff. And I would be scared because they were like, hey, we're going to run a credit report. And I'm like, oh my goodness, like my credit's probably and I had no idea what it was. And I'm like, I was almost apologizing for my credit score, not knowing what it was. And I think it came back, it was like in the 800s. So in a lot of ways, credit is a good measure of your dependability and reliability and kind of your overall financial health, but also like not really, because you can have a fantastic credit score, but also be,
right.
not necessarily, positive on the balance sheet, and things like that, or at least moving in a positive direction. So we definitely look at this as, a key piece of the financial plan, and make sure that, and I really break it down into two pieces. You have your credit, when we talk about credit, we have your credit score, and you have your credit report, and those are the things that we kind of break down, and then we go into things like identity theft. But those are the two main pieces that we kind of work through.
Yeah, and I'm glad you said that, Tim. That we shouldn't confuse a good credit score with necessarily meaning that that you have a sound financial position or situation. Maybe that's true.
Yeah.
We hope that's true, but as we'll talk about how credit scores are determined, that may or may not connect with your net worth, that may or may not connect with your debt position, your
Sure.
asset position. And I think I would encourage folks too. I've made plenty of financial mistakes, but one of the mistakes that I made related to credit is I underestimated the importance of credit based on my situation in the moment. So, I can think of several years ago, right after we paid off our student loan debt, where I really wasn't worried about, having, a sound credit history. We did, but being able to continue and maintain that, because I had really thought, okay, we've got no more debt. What's really the need for credit going forward? We already purchased our home. But I think that speaks to a common situation that people may fall into, similar to ours, where you look at your financial situation for the future through the lens of what you're doing today, right? And not
Right.
think about, what about a future home purchase? What about a real estate investment purchase? What about starting a business in the future? What about X, Y, or Z that may be important to be able to have that credit down the line? So thinking about, where the future may go as well. So
Yep.
you mentioned, Tim, two important pieces here: credit report, credit score. So let's jump into those both in more detail, and let's talk about the credit report first. So where do you pull a credit report? What does it show, and why is it important to check it?
Yeah, so I would say, even before we get into that, I kind of want to back up and kind of just talk about like how really how the credit system works. So it really kind of starts with you and your behavior. So what where how you're getting credit, where you're so if we kind of walk through a scenario, let's pretend, Tim, that you're saying, okay, hey, I want to buy a car. You're going to go to the Honda dealership, the Toyota dealership, the Ford dealership, or whatever, and say you're gonna, you don't have the cash to pay, as most don't. You're gonna basically put a note on the car. So the creditor, they're gonna say, hey, we're gonna lend you this $20,000, and every month you're gonna pay this back, with an interest rate. So basically, your behavior of what you're doing with Toyota or a Honda or a Visa or what your student loans, your creditors are going to be reporting that back, your payments every month to these different reporting agencies. So the reporting agencies are Equifax, TransUnion, Experian. And then these agencies are going to be taking all of that information that are sourced by the creditors, and essentially they create these credit reports, which is just, kind of a record of of kind of your payments based on what the creditors are telling them. And then from there, they create this credit score, which is basically a snapshot of your reliability, or your likelihood that you're going to pay your debts back on time. And then if we kind of bring this back full circle, you then use your credit score to then apply for more credit. So it's like it's like this cyclical thing that happens with regard to the how credit works. Now, if we talk about the credit report first, the credit report, again, is a record sourced by the creditors of an individual's different credit, loan payments, et cetera. It does. One of the misconceptions, it doesn't show your credit score. So a lot of people, when I'll ask clients, hey, run your credit report, they assume that their credit score is there, and it's not. So back in 2003, Congress passed the FACT Act, the Fair and Accurate Credit Transaction Act, that gives free access to credit reports, but not necessarily free access to your credit score. So every year, every 12 months, you can run a credit report from each of the three major credit reporting companies. Right now, with the CARES Act, you can actually run this report weekly.
Yeah,
which is interesting. and sometimes need it given what's going on with some of the student loan services where we talked about that in the past. So to quickly break down the credit report, when you run your credit report, and you can do that at freeannualcreditreport.com, I believe it is. It's annualcreditreport.com. So you can go there and you can see all the different credit reporting agencies, and you can pick the one that you like. I like TransUnion. It's colorful, so they're all essentially the same, but TransUnion is kind of a prettier version. So you can pick TransUnion, and I would say don't run them all at the same time. Just run one. If you have a big discrepancy when we talk about credit score, then maybe run another one. So when you run your credit report, basically the things that you're going to be looking at is kind of your pertinent information. So your name, maybe aliases, your birth date, your addresses. I joke that I've lived all over the country. If I ever forget, like, okay, what was the address that I had in like Southern California when I lived there? I look at Amazon and I look at my credit report, because those are typically the best places for that. And then it might show like your occupation and things like that. But the meat of the credit report is going to be your account information. So it's going to show first any adverse accounts. So these are things that have like a negative report associated with that. So like a missed payment or something of that sort. And then all of your satisfactory accounts. So these are accounts in good standings with no blemishes at all. So that's really kind of and you'll see, like, when you look at it, you'll be like, oh yeah, I forgot about that account. Or this account's been closed for 5 years, but it's still going to show on your credit report for a total of 10. So it's kind of a little bit of a trip down memory lane, but it's a good exercise to pull their credit report, to look at it. We do that on behalf of clients, but I even tell clients, like, I'm not going to know, if something looks kind of fishy or out of whack, because again, I wasn't there, but I can kind of still look and provide feedback and overall, advice on how to, better improve the credit report.
Yeah. So again, annualcreditreport.com. You can do that once per year for free through each of the three agencies. Although, as you mentioned here, in the CARES Act time period, you can do that more often. And would certainly challenge and encourage our listeners that have not done that. I think it's a great exercise for the reasons that you mentioned, but also just another way that you can be engaged and involved in your financial plan, as we talk about credit being an important part of the financial plan. So, Tim, you talked about one misconception around credit, which is that your report does not include your score. Those are two different things. What are some other common misperceptions that you hear about credit that we can debunk right now before we go into talking about credit scores?
Yeah, so some people think that like, oh, like if I check my credit, like it's going to drop, and that's not true at all. Like, the government actually is wants you, like, before you had to pay for your credit report. Now they're giving you free access. Another big thing is, closing. And some of this sounds like counterintuitive, but like closing an old account improves your credit score. And in fact, I actually just had this happen in one of mine. I had a very old credit card that I think I used when I was at West Point that eventually it eventually like closed because I just stopped using it. And my age, we'll talk about different factors that affect your credit score. Yeah. Age of credit is going to be one of those. So that long-standing account that was open basically cut my age of credit in half, which lowered my credit score. So that's another big one. Another thing is like, hey, if I have a missing payment on a credit card and I have a derogatory mark, if I basically get that back to where it's good to go, then that comes off my credit. And that's not true. Like I think it was back in 20, and I actually show it on my credit report when I go through this with clients. Back in May of 2010, I went 30 days over. Like I didn't pay my credit card, and it went 30. Once it hits 31 days, then it basically is a derogatory mark. That stayed on my credit report until May of 2017. So it can be, some of those things can be, very long in terms of them coming off.
This was the old Tim Baker, right?
Yeah, this is the old Tim Baker. I actually want to go back to my calendar and see what was going on, because I'm pretty, I kind of joke, the two things that I wouldn't say it's just two things, but the two main things that my parents taught me about money growing up, was, don't have credit card debt, like pay those off, and then like buy a house. That's a good investment. And I obviously didn't listen to that first one, 100% of the time. So, but that derogatory mark stayed on my credit report, for 7 years. So, this is where we talk about like auto payment and things like that. Like, don't, make sure that you're, and for some people, they're like, 30 days, like, they just throw up their hands, and then the next 30 day, that's another derogatory mark. And then, if it goes to 90 days, like, so like, you don't want to let those cascade. And then probably another one is like, being a co-signer doesn't make you responsible for the account. That's exactly what it does. So lenders like co-signers because it's two different people that they could potentially, revert back to if the credit goes, if the loan goes into default. So that's exactly what that does. So that, you got to look at that from some people are like, oh yeah, well, I'll co-sign for my brother's car note or my kids or things like that. And you got to be wary of that, because at the end of the day, you want to protect yourself. You want to help loved ones, but you also want to protect yourself, in terms of your credit. And probably the last one that, you hear is like, oh, well, if I pay off this debt, my credit is going to be boosted by, 50, 100 points. And there's just so many different, it's not a linear relationship. There's so many different factors that go into your credit score that it's going to depend on a variety of things of how your credit score is going to move.
Yeah, and I think that last point's a good segue into what is a credit score and what makes that up, so you can have an understanding how any one decision, may or may not move the needle very much based on the components and the percentage that they make up of that overall score. So give us the broad definition of a credit score.
Yeah, so the credit score is really a number that summarizes your credit risk based on a snapshot of your credit report at a particular point in time. It's really the picture of your ability to pay back a loan over the next 2 or 3 years. So the higher your credit score, the more likely you'll be able to pay back the loan and on time. And really the credit score matters because it affects whether you can get credit and what you pay for credit. Meaning, if you have a higher credit score, that you can potentially get better rates. A higher score, will more than likely be more chance of approval for that credit. It can affect your ability to rent an apartment. Sometimes it affects your ability for your deposit on a telephone, a utility, that type of thing. And a lot of employers will run credit scores just as a kind of a measure of your dependability. So it can have far-reaching effects. So, if we look at kind of the different bands of credit, so it's like some people will say, oh, like my credit score is only 760. Like that's a really good, that's like in essence, that's an excellent credit score. So anything above 750 is excellent. Good is kind of the 700 to 749. Fair is 650 to basically 699. And it goes all the way down to, poor than bad credit. So this is a really, really important score. And if you look at it from, I try to look at it from both sides of it. So you look at it from the lender's perspective, when, and we talk about this, like we kind of talk about this with like interviewing like candidates and things like that. You're trying to really get a good snapshot of this person, and by answering a series of questions or something like that. And from a credit granting the decision, the lender is really trying to get a good snapshot of how, hey, if we're going to take risks to lend you this, $300,000 for a home, we want a good feel that you're going to be able to pay this back and on time. And from their perspective, they're using that as a way to sum up your dependability.
Yeah, and I don't want to brush over. You mentioned it, but not only impacting your ability to get credit, but what you pay for that credit. I mean, that's so incredibly important when you talk about big purchases like a home. And we talked about this in episode 159 with the refi. And what is the difference of a point or a point and a half? And that can be due to credit and how attractive you are as a lendee. But obviously that has significant impacts on your monthly budget as well as over the life of the loan, student loan refi, car buying, the list really goes on and on, real estate investing and so forth.
Yep.
So you mentioned the number and the ranges that we see in a credit score. We talked a little bit about why it matters, what it can impact the various parts of your plan. Talk to us about the new FICO credit score effective January 2020.
Yeah, so they're trying to tweak the system a bit to kind of make it more of a reflection of like a borrower's behavior. So one of the things that they changed at the beginning of the year, and FICO's the biggest credit score out there. I think Vantage is the next one, but FICO's the big one on the block. Mm-hmm. They're trying to tweak their algorithm, so they're going to judge more harshly, those who fall behind on payments. And what they're trying to do is give more weight to people that are basically improving their credit situation. So they're looking at more like trended data. So the example I'll give is, let's pretend that you have $40,000 in credit card debt, and we work with clients that have $40,000 in credit card debt. And let's pretend that over the first year that we're working with them, that $40,000 moves to, $20,000 as an example. And then we basically compare that to another client that we're working with that just basically has, we'll say $5,000 in credit, but at the end of the first year, they still have $5,000 in credit balances that they're carrying. The first client would actually be, graded out a little bit better because they've gone from 40 and their trended data says they're moving in the right direction in terms of paying off their credit. Whereas the other client, which is we're kind of just saying they're treading water, their balances are the same, would be, graded more harshly. So today, that second client, that 5,000 is before we made the changes, would have a better, credit rating. Whereas the one that's trending in the right direction now is they're given more consideration to that, which is good. I think the other thing that they were looking at to change in is to kind of you can play a little bit of a smoke and mirrors game with credit. So if I had $40,000 in credit card debt and I moved that to an unsecured personal loan, that actually helped my credit score out quite a bit. So now for those types of loans where you're kind of, just shifting it from a credit card debt to a personal loan, it's still graded similar to how like a credit card, would be. So they're recognizing that there's a lot of people that will consolidate, credit card debt into other types of debt, and they want to make sure that they're capturing that data accordingly. So
Sure.
they're going to continue to it's not a perfect system at all, but they're trying different ways to make sure that they're capturing the overall behavior and where a particular borrower is trending with regard to their credit decisions.
Yeah, and I think that makes sense in terms of the trends and I think about this in terms of like when we admit students into the PharmD program, you're looking at the whole picture, but often, the best indicator of their success going forward is the most recent behavior. So, if you see somebody who really struggled academically in their first or second year of undergrad, but they've significantly improved in their third and fourth year, obviously that's an indicator of where they're going to go, even though overall they may not be as competitive,
Right.
some students who did average throughout. So let's talk about a credit score and how it's calculated. So how is a credit score calculated? What factors are considered in this calculation, and what's considered high impact versus lower impact?
Yeah, so there's really 6 different factors that kind of go into your credit score. So we'll start with the high impact one. So there's 3 high impact one, and the first one is credit card utilization. So the credit card utilization is it's basically the amount of credit that you're carrying month to month. So if we say that, and really in this is a high impact factor, the lower the utilization, the better. So lenders like to see that you're not using too much of your available credit. So the more you use, the harder it is to pay off. So the idea is to keep the balances, low. So the example I give is, let's pretend that you have a line of credit on your credit cards of $10,000. So if you're carrying, $3,000 worth of credit card balances every month, then your utilization is basically 30%. And in that, you would be kind of right in the middle of the pack. That's kind of a fair, credit utilization rate. So the idea here is that to be excellent, you want to have basically under 10%. So in that case, the borrower, if they want to have an excellent credit card utilization, it would be carrying $1,000 or less. Now, obviously, we're big believers of just paying off the credit card every month. But that's a big one, is that lenders like to see that you have a little bit of rope but you're not using all of it. The second one is kind of the payment history. So lenders look at this factor to determine how likely you'll make future payments on time. So that's like not being like me and making sure that 100% of the time you're paying your debts back and on time. So you want to be aware of lateness. You want to set up things like automatic bill pay, those types of things, and not let those latenesses cascade. And for you to be excellent here, you really want to be 100% effective. Good is 99%, fair is 98%. And you're going to say, wow, Tim, that's really tough. But if you think about it, think about like if you were to pay off a student debt, like let's pretend you refinance your loans and a couple years ago, and you made your last payment in July of 2020. Those payments and that account is going to stay on your credit report for 10 years. So it's not going to come off until July of 2030. So if you add up all of these different accounts and all of these monthly transactions, like the denominator is very large. So you even if you do make miss a payment, you're still going to be in that 90 high 90s. Probably the last high impact factor is derogatory marks. So these are basically the result of things like a late payment, or if you go to collections or have a bankruptcy. The derogatory marks are going to be anything that's adverse that a creditor is going to want to know. So this is high impact. The lower, the better. And again, these are where you want to make sure that you're keeping all of your accounts in good standing, and they're not basically moving from an account in good standing to an adverse account. The other ones are going to be, so the age of credit is more of a medium impact. So the higher or the longer, the better. So they're looking at really 9+ years. So this is where some younger clients get penalized. I actually had a client that was, I think she was 28, and her age of credit was like 38 years old, or 38 years. And I was like, what's going on? And I think her parents put her on like a Sunoco gas card as like a user or whatever. And that like really helped her credit history. So lenders like to see that really it's not your first rodeo. You have experience using credit. So you can improve your age of credit by keeping accounts open and in good standing. The next one is total accounts. So I thought this was like, when I was learning about credit way back in the day, I thought this was a little bit of counterintuitive. Actually, the total accounts higher is better. So lenders like to see that you're using various accounts. So it could be installment accounts, so loans paid in fixed increments over a period of time. So think of like a car loan, a student loan, a mortgage. Could be revolving credit, so credit lines that have variable payments. So think of like a credit card, an open credit line, which could be things that are balances that need to be paid every month. So think of like a utility over a cell phone bill. So it suggests that it's kind of a little bit of the herd mentality. It suggests that other lenders have trusted you before, so we can trust you as well. So they like to see, lots of different, and for you to be in the upper echelon here, excellent is like 21 accounts or more. And you're thinking like, wow, that's a lot for pharmacists. This is typically a piece of cake, because every time your loans are dispersed, so think like per semester, that's an account. So pharmacists usually have a really easy time of getting this, even if they don't have credit cards or things like that, they typically have a lot of accounts listed on their credit report.
Unfortunately.
Yeah, unfortunately.
It's really easy.
And then finally, the last one, and this is a lower utilization, is like a hard inquiry. So this is lower is better. This results in applying for credit. So the idea here is that they don't want people that necessarily don't have great credit to kind of be fishing for credit like all over town, essentially. So you're applying for credit and you're just trying to find somebody to lend you money. So instead of, and that's kind of like a shotgun blast, you take a sniper approach. So like if you're going to buy a car, you're gonna narrow it down to the dealership or two that you're looking at, and apply for credit there instead of like just going everywhere. So these hard inquiries stay on your report for 2 years. I feel like I have a bunch of these from refinancing my house. I switched from Sprint to Verizon. They check your credit there. So ways to kind of get around this is you can take advantage of like pre-approved credit cards where they've already kind of pulled your credit. If you use that car buying example, if you say, hey, you apply for credit at Ford, Toyota, Chevy, etc. If they're within a relatively short period of time, like I think it's like a week or two, they group all, like it might be like 3 or 4 inquiries, so grouped together as one. But excellent is that 0 to 1. I think for right now on one of my credit reports, I have like 3 or 4. And again, my credit is in the 800, so it's not a big thing, but it is something that they want to kind of keep tabs on, because they don't want people just fishing for credit. So those are really the different factors that kind of go into your credit score. So
before we talk about hard versus soft pull, because I think that's an important distinction that many of our listeners would be interested in, I want to go back to that first one, credit card utilization, because I think this is one where people might be surprised by that number of less than 10% or even trying to get below 30%. So I imagine there's many people out there that might have, one major credit card that they use, all their monthly expenses go on there. So they're putting, $6,000, and they're obviously above that threshold. So what's the play here? Is it trying to get that limit increase? Is it having multiple cards to diversify those expenses? What do you typically advise or work with clients here?
Yeah. So, it's something that I think you have to kind of tread carefully. And I kind of, depending on the client that I'm working with and like the situation that we're in, I'll advise them, accordingly. So, one of the ways to kind of game the system is if you say, hey, I have $2,000 worth of purchases of balances that I'm carrying, and I'm in a $10,000 limit. You're in that 20%, which is not necessarily excellent. So one of the things that you could potentially do is ask for a credit increase, a credit line increase. So again, you're increasing that denominator that kind of gets you, if you go from 10 to 20,000, that gets you kind of in that excellent band. I've done that in the past, or I've suggested that to clients in the past, and it's worked, especially clients that are trying to get into from a 740, 745 credit score to a 750, and they're like on the verge of buying a house. But if I also know that client struggles with credit card debt, like I wouldn't necessarily suggest that, because now we're just giving them a bigger chasm to kind of tumble into. So there are ways to kind of game the system. I think, again, FICO and Vantage, they're kind of trying to figure out ways to kind of, get around that. But the utilization is still very, very important. If you're maxing out your cards all the time, like, lenders want to know that. So yeah, I mean, I think it depends on it's just so much like everything. It kind of depends on the situation and the person that we're working with. But there are ways to kind of, I kind of say game the system, because again, you're not really changing anything about your own behavior. You're just kind of changing the numbers in the calculation and getting a little bit of a better score. So just it's going to depend on the situation. But I would imagine that they're gonna, and I've also had clients that I've suggested that to, that have come back and they're like, and actually the creditors push back on that. So it's not, it used to be that, and in some cases it still is, it's like, yeah, they're like, no problem. If you want to spend more money, we'll definitely collect the interest. But I think they're trying to find ways to kind of make that a little bit harder, so they know that, it's not, just for kind of gaming the system.
Yeah. So hard and soft pull on your credits. What's the difference? And give us an example.
Yeah. So typically I think for all three of the credit reports, at the end, you'll see kind of your soft pull. So you'll see like, hey, I've never done any type of business with like Discover Card, but you'll see them on your credit report.
Yeah.
And what they're doing, it's kind of, think of it as like a marketing. So they're paying the reporting agencies to basically say, okay, like show me the people that have, a score from, 700 to 750 or whatever. And they're basically looking at your credit and devising, a marketing strategy or deals for you to potentially. So that's why you might get a mailer from Discover, because they pre-qualified you for a deal. A hard inquiry is performed when you actually apply for a loan, like a credit card, a mortgage, and the lender checks your credit history before granting or denying the loan. So these are the ones that basically stay on your report for 2 years. Whereas the soft ones, they don't really have, they're recorded, but they don't really have any sway on your credit history at all. And it's kind of something that's, good to review, but they're not really, they're not really going to move the needle in terms of it. So like when you go to refinance your loans, to get a quote, they might do a soft pull on your credit, and it's not going to affect anything. But then actually when you go to apply, they'll do a hard pull, and that results in a hard inquiry, which will then be on your credit report for 2 years, and it could potentially tick your credit down for a little bit. Like I said, it's not going to move the needle much, but those are the big differences between the soft is kind of like where you're just checking things out. The hard is where you're basically signing papers for a particular loan.
Yeah, and student loan refi is a good example. I think that for our audience that may hit home, where they're initially trying to gather rates across multiple companies in terms of soft pull, but then they ultimately move forward with one in terms of that full application, signing papers, and that's where that hard inquiry would come from.
Yep.
So let's wrap up by talking about identity theft. What should somebody do if they find out that their information has been compromised, or that someone has stolen their identity, is making charges out of their accounts, or perhaps some listening want to be proactive and try to protect their identity and information? What advice would you have there?
Yeah. So I think this is kind of, I think in kind of the world that we live in, it's not necessarily a question of if, your identity is going to be stolen. It's really a question of when, unfortunately. So I want to say, I don't know, every other month, once a quarter, a client will say, my identity's been stolen. Like, what should I do? We typically kind of go through, like, we obviously contact that creditor, and we shut it down. You want to run a credit report, you want to dispute, and a lot of banks, like, I'll get alerts and things like that, and they're like, hey, is this yours? And I'm like, no. So a lot of the banks have mechanisms in place to kind of protect you, but it also kind of gives you a little bit of a false sense of security too. So you want to make sure that you're checking your reports regularly. And I tell clients, I try to do mine personally, like when the clocks change. So when they fall back and they spring forward, it's just, like when you change the batteries in your smoke alarms. So I think it's a good practice. And one of the times I checked mine, I want to say this was, I don't know, maybe 5 years ago, I checked my credit report, and it wasn't necessarily identity theft, but there was a credit card that I shared with an ex long ago that just popped up on my report, and it affected my credit a lot. So I went in and I disputed it. You can go on to whatever Experian, Equifax, TransUnion, and dispute those online. And then I basically puts the onus back on the creditor to basically, say that this is a legit thing. And it was clear from my credit report pretty quickly. So probably the biggest thing, though, outside of kind of being, aware of your report and your score, is looking at either like a credit freeze or a credit lock. And they're going to be very, very similar, but there's slight differences. So both are ways to protect your credit reports from being used by scammers to open up new accounts or file your taxes, with your social security number. These are often used interchangeably, but they're similar, but there's slight differences. So the freeze, you can freeze your credit at each of the three credit reporting bureaus. It essentially restricts access to your credit report, and lenders can't see your information until you unfreeze it. So it's really a good protection against fraud. And unfreezing it could require, your name, social, a password, maybe even a PIN. And this is going to be free by federal law. Federal law requires free credit freezes and unfreezes. The lock is where you restrict most lenders' access, and you can unlock your credit report immediately at any time. And sometimes that I don't think right now because of COVID, but some of these, this is like a charge. So there's a monthly fee that's, you pay to a credit bureau. Again, it's a preventative measure to prevent, scammers, but this is not governed by federal law. So under the freeze, you're kind of protected. Under the lock, not necessarily. So I would always kind of revert to the freeze, freezing your credit when I've done it. And if you're not making any credit granting decisions, you're not buying a house, a car, refinancing anything, it probably makes sense to go through and freeze your credit. It probably takes about, 3 to 5 minutes each, for each of the, and then, to freeze it and then call it a day. So you're going to need things like your, identifying information, your name, address, birth date, social. You might be able to, might be required to basically set up a PIN for that. So that's going to be very, very, very important to protect. But this is going to prevent people from basically, opening up fraudulent accounts in your name. And then when you go to make a credit granting decision, you just unfreeze it. So it's kind of just a good defense rather than just keeping it unfrozen and open all the time. And believe it or not, this happens. Yeah, I'm sure many people listen and they're like, yeah, that's definitely happened to me. I've had that situation. Mm-hmm. And it's typically not until you either kind of talk to me about this or you have a big loss that you're like, yeah, I'm keeping it frozen because it's just not worth the time and the hassle to kind of go through, mitigating, losses or just the hassle of a identity theft event.
Great stuff. Tim Baker as well, a topic that has been long overdue for us to talk about on the show. Yeah. Three years in, we finally got to it, but I think this episode is a great reminder of the comprehensive nature of the financial plan. And we talk about this over and over again because it's so important that when you're working one-on-one with a financial planner, it's not just about debt, it's not just about investments, it's not about any one given part of the financial plan. You have to look at really the whole spectrum. When we say comprehensive means anything that has a dollar sign on it, we want to be involved with.
Yeah.
And I think this is a great example where credit can transcend so many parts of the financial plan. It really speaks to the power of having a financial planner in your corner. So for those that are interested in working with YFP for comprehensive financial planning, make sure you head on over to yfpplanning.com where you can book a free discovery call. And as a reminder, show notes for this episode and every other show that we do, you can get access by going to yourfinancialpharmacist.com/podcast and finding the episode and getting the resources and information that we covered on that show. And please don't forget to join our Facebook group, over 6,000 members strong, pharmacy professionals committed to helping one another. And last but not least, if you like what you heard on this week's episode of the Your Financial Pharmacist podcast, please leave us a rating and review on Apple Podcasts or wherever you listen to your podcast each and every week. Have a great rest of your day.